Welcome, everyone. I'm Angelo Robles, host of the Angelo Robles podcast. I'm also the founder and CEO at Family Office Association. We have a great session today. 2021, Expect the Unexpected, a macro perspective, featuring Daniel Lacalle, professor of global economics and finance and economist. It's a tremendous pleasure to have him on. Daniel, welcome to the show.
Thank you so much. Thanks for having me.
And I'm in snowy Connecticut, a suburb outside of New York, and it has its little charms, a little bit of snow here and there, but Daniel's in Madrid, and it may be a little bit more dynamic where he is. So I may be slightly jealous. That may make its way into my questioning if I sound a little angry today. I'm not really a big snow guy. Why don't we begin? Modern monetary theory, MMT advocates contend that governments that have their own national currencies do not have budgetary constraints. The belief is they can never run out of money. Therefore, a government doesn't need to worry about accumulating large debt. You and I think logic would tell us there's going to be consequences to this. What's the problem, or maybe you feel otherwise, with modern monetary policy theory?
Well, the problem of modern monetary theory, the first is that it's not modern. It's not a theory. It's been implemented for decades in numerous countries with the same result, which is a disaster in the economy. We need to understand what debt is, and we need to understand what money is. The ability of a government to issue debt is directly related to its ability to repay it, and the belief from investors that liability, which is debt for the government, is a good asset for the investor. When the questions about solvency and the questions about the use of that debt start to mount, then the entire cookie crumbles. So you see that the currency starts to devalue and depreciate dramatically, and that the global demand of currency, local currency denominated debt evaporates. Any citizen in an emerging economy knows that the global demand, for example, of Argentine, Brazilian, or Colombian debt in local currency is virtually inexistent. And so they do have their own currency, but they have to issue debt in US dollars. Do they have to issue debt in US dollars because they don't understand the beauty of the magic money tree that the modern monetary theory presents? No, they cannot issue in local currency because there's no demand. And this is the problem with modern monetary theory, is that it does not understand global demand of money and considers that supply is eternal, which is untrue.
Very much. So, what's the big problem that we have here? We have massive debt. We still have the issue of COVID-19. We hope there's some light at the end of the tunnel, and it does appear that way, but things don't work so linearly. There's probably going to be some level of setbacks. In theory, the virus could be with us for decades or longer, but of course we'll have ways, we hope, in terms of managing it. There's unemployment issues. There's so many different problems happening around the world. That's going to lead a lot of my people of interest to say, what are we heading to? Deflation, inflation, hyperinflation? Where do you think we're headed? Short term and a little longer term?
I think that short term, we're going to have an important inflationary spike for three reasons. No? The first one, obviously, is the reopening of the economy generates a base effect that is very aggressive. No? The second one is that the economies that have recovered faster, the Asian economies, are very intensive in terms of the use of commodities, iron ore, oil, gas, etc. Therefore, those that are growing faster are pushing demand higher in a moment in which the third element is pretty evident, which is that throughout 2020, some of the supply chains have been severely damaged. No, so we're going to see, and I think it's pretty evident in the latest data, a spike in inflation. But once the base effect and once the reopening effect is sort of diluted, then the risk is actually that we enter into a massive debt deflation spiral. Fundamentally, because most of the developed economies have used the fiscal space of 2020 to zombify parts of the economy.
Mhm.
And in order to avoid the crisis, they have kept numerous sectors that were already in overcapacity in 2019 alive and therefore zombified, which makes a very complicated exit from the crisis, an almost K-shaped recovery in which a few sectors, technology and everything that is high added value, comes back very quickly, even ended 2020 above the levels of 2019, while at the same time, what we see is that the sectors that are less productivity growth, the services sectors, tourism, retail, etc., all of those recover much slower.
You gave a lot to chew on there. My audience is usually going to be very active investors. So inflation, then deflation is going to be very important in terms of how tactical they'll be in their portfolio. We're going to get to that probably in 3 or 4 more minutes. But I would like to ask, staying on the theme of inflation, supply, and demand, if the definition of inflation is too much money chasing too few goods, doesn't that make inflation very specific? For instance, it all goes back to relative supply and demand. I'll give an oil example. Oil demand, of course, is lower during COVID, but if the supply is cut more than the demand is destroyed, since oil is needed for certain things, the price will rise.
Absolutely. Yeah. One of the things that we have seen in 2020 is the above average recovery in some of the commodities in which supply constraints have been managed by either a cartel, like in oil, or by the decision of one of the suppliers to put the brakes on production, for example, like we saw in copper. No, so I think that in general, but there's a monetary effect as well, and we should not forget it. I think that if we strip aside the supply-demand scenario with movements, artificial movements from the supply side, I think that what you can see in the commodity complex is a correlation with the excess of money supply relative to nominal GDP. In many occasions, we read that, well, there's been massive money printing for many years, more than a decade, and there is quote unquote no inflation. First, there is massive inflation where money goes, which is fundamentally to risky assets. When you use that money growth to buy sovereign bonds, obviously artificially low yields and hence very high prices of sovereign bonds is a consequence of monetary policy. But at the same time, what we have seen is that the way in which the CPI basket is constructed disguises a lot of inflation. For example,
Yes.
in the euro, I think that any American understands this perfectly. Now, is that you see that that inflation is 1.6%, yet healthcare is up 10, education is up 10, fresh food is up 6.5. The rent is up 5. I think that there's a lot of things that are outside of the calculation of CPI. In the case of the Eurozone, for example, it was pretty evident. You saw that in December, the Eurozone inflation was negative. However, the fresh food component was up almost 3%, whilst at the same time, the CPI, consumer price index, was down because of a 6.9% fall in the energy part, but no Eurozone consumer has seen his or hers energy bills come down 6.9%. Why? Because the CPI does not take into account taxes and subsidies that are included in the household bill. So unless you consume crude oil barrels taken from the port, you have not seen that level of, let's say, disinflation that the headline CPI showed.
For sure, I completely concur. I mean, I believe one reason it's a little bit negative in one way, why the government quasi-artificially contains the CPI, is because certain benefits that we do in social security payments and others to people, they want to contain that. They don't want that going up 5 or 7% a year. It'll be more of a burden on the government.
Absolutely.
I've been saying for a long time, and I would say most people don't appear to agree with me that I have on relative to what you said. When you're extremely affluent, and I know that's a fortunate position to be in, whether inherited or whether through hard work and entrepreneurship, it doesn't matter. If you're living somewhat that lifestyle, living in New York, having a second home in London, having a beach house in Malibu, California, healthcare, education, your inflation is not, the CPI is a joke. It might even be 10 or 15% a year for you. Now, yes, if you own those assets, they may be appreciating, but if you want to either buy them or buy more or buy a soccer team in Europe, that's not going up 1 or 2% a year.
Absolutely. One of the things that has been studied by Professor Cavallo and others is also not just the overall CPI inflation, but CPI in the different segments of society. And one of the things that is shown is that the inflation that, for example, the less well-off suffer is significantly higher than the inflation that the middle class, let alone the upper class, perceive, for a fundamental reason, because more of what they consume on a daily basis is food and things that actually are going up, like utilities, etc. It is only when you start to go into the middle part is when you see that reduction, because the one consumes more hospitality, services, etc. But it's very interesting what you just said, is that it is well studied that the so-called 1%, no, the 0.01% is seeing much larger levels of inflation. Why? Because, as you said, it might be that in CPI, healthcare services are going up 0.1%, but anybody in this discussion here that has a private healthcare program knows that the bill for 2021 is not down yet, let alone up only 0.1%. And the inflation in assets is enormous. And it's enormous in real estate. It's enormous in all of those assets in which investors are parking their savings in order to preserve the savings from the monetary destruction created by central banks. That's why, obviously, it's no surprise that in the age of massive money printing, that house prices have gone up much faster than real wages, and that the savings rate in the economy, or that, for example, infrastructure assets have gone from, at the beginning of 2008, you would think that 9 times EV/EBITDA in an infrastructure asset was expensive. Today you hear 15 and it's almost as cheap, no?
Yes, it is. And maybe related a little bit to both corporate America and real estate, but not residential real estate. Survey data shows that the percentage of people who prefer to work from home 5 days a week pre-COVID was about 24%. Post-COVID, or during COVID, I'm sorry, it's about 61%. And 95% would prefer just to go into the office 1 day a week. We could argue good or bad. I'm going to say long-term, potentially good, that we could have a global workforce, be based from anywhere, technology, et cetera. And technology is a deflationary driver. We may get a little bit to that later. But this is a perilous time for real estate owners in, I would say, retail, office, and hotels. Part of it's going to depend on their leverage, how much cash they have, how much they could wait it out, and how they could adapt their properties to a new world.
Absolutely. I think that the COVID-19 crisis has accelerated a paradigm shift that I think that the survey that you just mentioned shows was already evident before. And I think it's accelerated a different perception about mobility, a different perception about the requirement of office space, of retail space. I think it's going to be a very, very difficult period for any of the companies that do not understand that that process has probably been cemented and is not going to revert back to where it was in 2015, 2014. And I think that we are also experiencing the longer the period of even partial lockdowns goes on. What we are perceiving, for example, with my colleagues and my business associates in the office, is that it is much more difficult to convince people to go back to the ways in which business was conducted before. We all have spent hours on end on a meeting. However, when we have a Zoom or a I don't know, or a Microsoft Teams meeting, everything is much faster because we understand that that it's not that we cannot just consume time for no reason, no. So we become on one side more efficient from the perspective of what used to be endless meetings. On the other side, as you mentioned before, it is long-term deflationary because mobility is a massive driver of the multiplier effect in GDP.
No doubt about it. Legendary investor Jeffrey Gundlach said something to the effect of that once the pandemic began, the first layoffs were, well, no surprise, travel, leisure, hospitality. But as the economy restructures, layoffs will climb the income ladder. Do you agree?
I think so. One of the risks that I have mentioned a few times about this sort of I would say comfortable way in which so many levels of workers and finance and so many other areas are living this pandemic is not understanding that after working online comes laying off online. Is that a lot of the things that maintained some jobs. Imagine, for example, corporate banking, investment banking itself, so many things. No, we're going to see a significant reduction in workforce in areas, consulting, for example. I was the other day at the headquarters of one of the big consulting firms. No, seven entire floors of offices, and I said to the president of the company, I said, how many of these people do you think you don't need? And he said, no, we now know that 20% are completely unnecessary. We now know it after a year of
Right.
Developing of continuing to develop the business, of continuing to adapt. We know that there's a slack of about 20%. My first thought was that it was probably underestimated.
Yeah, no, I actually would agree with that. And that's going to be some of the concerns that we discussed a little bit earlier. I mean, the consumption of goods has grown, but there's less employment. This is kind of the dark underside, I guess you could say, of the stimulus. Consumers are spending more, but in ways like online retail that really don't create more jobs. If anything, they have the reverse effect on it. I mean, this is a perilous time, like I said earlier, that we're going through.
Well, think about this. How many times have any of us gone to a shopping mall, spent a few hours, browsed, maybe bought a couple of things that we actually weren't looking for in the place, had lunch, came back, and maybe we were going to the shopping mall to buy golf clubs or something specific, and came back with more than we expected, and at the same time grabbed a coffee or had lunch. That entire experience is gone. You need golf clubs, you buy golf clubs, you leave. Maybe you buy things that you actually don't need as well. But again, I come back to the point, the impact, such an important effect of mobility in GDP, and with it job creation. So one of the things that we see from this crisis is threefold. No, there's three things that I think are important. The first one is, in this crisis, unlike in most other crises, the companies that are falling like dominoes are not the ones that were extremely leveraged or that had very bad strategies or were conducting the wrong businesses. The companies that are falling are the ones that were doing nothing wrong. They were living day to day, paying the rent and salaries and surviving with a little bit of cash flow, and then the economy was shut down. So it's basically literally as you have your house and somebody's put a brick wall in front of the door and you cannot get in. No? So that's an important factor in terms of job creation. Why? Because once the economy comes back, the problem is that the biggest job creators are usually in newly created companies and in the smaller segment, in small and medium enterprises. And those two have been severely affected by the crisis, because newly created companies are not happening because there's too much slack in the economy, from what I mentioned before, the zombification of what already existed in 2020. And the second one is because the small and medium enterprises that have collapsed were not the ones that were highly levered and wrongly placed in the economy. The ones that are falling are actually the ones that have been kept alive and zombified are actually the ones that were highly levered and in the wrong place before the crisis.
Very much true. It was formed in the US, I think, under a Bush 41 back in the late 80s. It's loosely defined as the plunge protection team, meaning the government wants to stabilize the financial markets, specifically the stock markets. Therefore, it really doesn't want significant long-term, quote unquote, well, it's plunge protection. Now, did it work so well in 2001, 2008, and in March of last year? Well, it's never going to be perfect. But what I'm basically getting at is the government could I go with the word artificially, through interest rates and other strategies, prop up certain companies where maybe their PE ratio, the math, doesn't make sense, or are tech companies devoid of any classic math and what we would think of as PE, because it's just valued differently.
I agree. I think, obviously, massive liquidity injections in periods of growth and periods of recession without any actual reduction in the balance sheet of central banks, etc., and constant reduction in rates, those absolutely benefit massively the first recipients of money. When everybody's talking about inequality, right, these days, the first measure of inequality that is extremely evident to me is the fact that massive money printing and very low rates benefit the ones that are indebted today and the ones that have access to assets today, and make it very difficult for the ones that don't have assets and that are not indebted to get credit or get assets. No? So it makes artificially expensive the existing asset at a price which we will have to understand in the future, but definitely the rise in valuation of technology companies is a direct consequence of massive central bank intervention, because unquestionably technology companies, particularly the ones that are already IPO'd and the ones that have already uh, gained a market share, are the first and biggest recipients of that money. It's an indirect subsidy, and that generates massive multiple expansion, whilst the competitors and the ones that could be becoming the competitors to those giants don't have access to credit, because the solvency problem that exists in the economy remains in a way in which it continues to create a relative credit crunch to the new entrants in the economy. So basically, central bank action benefits disproportionately government spending and deficit spending via the repurchase of sovereign bonds, and benefits the incumbents in the high productivity and high growth sectors, in the sense that it massively pumps up their valuation and they get much larger access to capital.
Yes. And back a little bit to kind of that central banking type question, the demise of the dollar has been, we've been talking about it for years. I don't think it's going to happen anytime in the relatively short term, mainly due to what else could be out there, the yen, the franc, the Chinese renminbi. I don't see that happening in the future. Could there be a basket? Could they go back to SDRs? How do you think this will interplay with central banks, the US Fed, the IMF, and the global currency?
Mm-hmm. I mean, the demise of the US dollar is impossible because there's no alternative.
It comes down to that, yes.
It's, it's like when Elvis said, why I am the king, because there's no other that can be there. There's no contender. No, and I think it was Bruce Springsteen that said, "There's no contender." Huh? That's why Elvis is the king. So the dollar is the king, not because the dollar is the king, like Elvis was the king, not because it's better, not because there's no contender, and because any of the contenders cannot become, of the possible contenders, cannot become contenders by conducting the same monetary mistakes that the Federal Reserve commits. So if the Federal Reserve takes excessive measures in terms of monetary policy, but it's the world reserve currency. And one of the things that I've learned from working with people that have worked in the Federal Reserve when I was at PIMCO and Citadel, I had the pleasure of working with Ben Bernanke and with Rich Clarida, people like that, is that the Fed is always looking at the global demand of dollars. The ECB is not looking at the global demand of euros to start with, because it doesn't know what is the global demand of euros. And the euro is the only world reserve currency with redenomination risk. Maybe if you're in LA or in Iowa, you don't get the news, but in the European Union, we hear all the time 1 or 2 or 3 populist parties talking about breaking up the euro. So the stability of the euro relative to the US dollar is more than questioned. The renminbi is the yuan is a dollar second derivative. The yuan does not exist without the $3 trillion of reserves that the Chinese government has. So if the confidence in the US dollar was to collapse due to whatever reasons, lack of trust in the monetary system, lack of trust in the government, you name it, the first thing that would happen would be that currencies like the yuan and emerging market currencies would collapse, because they are directly related to the dollar in the sense that for them, US debt is an asset. So if you think about it from a balance sheet perspective, if you're China and one of your key valuable assets loses its value, what happens to your currency, the yuan? The demand for that currency collapses, no? You may say, oh, but the Chinese central bank is keeping the yuan stable by constantly interfering in the exchange rate. Well, exactly. So what would they do? Devalue it 30, 40, 50%? Of course. So that is the problem, is that there's no contender, and the ones that could be contenders need a strong dollar to remain being a reserve currency. And that, how does that change? It may change, but it cannot change when you have China, Russia, the Eurozone, the Latin American countries, etc., all of them conducting the same aggressive monetary policies of the Federal Reserve without doing what my good friends at the Fed do constantly, which is understanding the global demand for dollars. Oh, so what happened last year was very evident. What does the Federal Reserve do? Massively increases money supply. Then you have all of the emerging economies increasing dramatically their debt in US dollars, because there's plenty of dollar debt available. And what happened with that is that the global demand of dollars increases because all of the emerging economies have increased their dollar denominated debt. So unless, you would need a cataclysmic event to change that. But I come back to the point, like Elvis, there's no contender.
Very well said. What would be one or several key economic indicators that you would look at or recommend to a family office and kind of putting the puzzle together? I know it's an inefficient world. Nothing is going to be perfect. Dynamics change, human behavior, etc. For some, it may be the 10-year treasury. For others, it could be gold. For you, what are key economic indicators to follow?
If I think of the main ones that I look at, I think that the leading indicators, PMIs, ISMs, are key to understand how the economy is behaving, because they include not just current expectations, but hiring expectations, etc. And relationships between some of the ones that you've just mentioned, like, for example, relationship between the US Treasury and the German Bund, the relationship between gold and the US 10-year, and the divergence between the DXY, the dollar index that is fundamentally relative
Dixie, yes,
to the euro and the yen, as compared to the trade weighted nominal dollar index, which is the index that puts the dollar compared with the currencies with which it trades. One is fundamentally, the DXY is fundamentally relative to the euro and the yen, about 70%. The other is relative to the currencies with which the United States trades. When the nominal trade weighted US dollar index recovers, is because there is a strengthening of the US economy relative to its trading partners. And when that happens at the same time as the DXY differential shrinks, is because the US is separating itself from the global economy in terms of improvement, if it shrinks, in terms of worsening, if it widens, no?
Yes. You brought up earlier, we're going to switch a little bit into broadly asset allocation, and we'll dive into certain sectors right after that. So you said, unlike other economists and macro thinkers that I've had on, so I like that it's different, that short term could be the inflation, but a little longer term deflation is going to be the concern. So the rule of thumb would then be, if we're about to head into inflation, having my money in cash and bonds is probably not the best idea if I want to get a real return and keep up with my true inflation. But eventually, when it hits a deflationary environment, having dry powder, flexibility, and what a treasury or cash could be in that point could be more beneficial. What I'm getting at is I suppose this is not a time just to, and it might have been for the last 10 years until COVID, to kind of set it and forget it, be strategic. Now may be a time to be more tactical. I think you have to be than ever before.
I think so. I think so, because if COVID-19 has proven yet again is that basically since the 1990s, each crisis is that economic cycles are shorter and more abrupt. And therefore, you need to be very tactical about things like a spike in inflation that is not long lasting. And that forces you to be exposed to the assets that are good inflation hedges in the short end of the cycle, obviously. So you don't buy, for example, you don't get into the assets that are exposed to an inflationary pressure going on for a few years. So I think that yes, we need to be tactical, because one thing that I think is going to differentiate 2021 from the previous 3 years is that it's going to be more similar to 2018 than we would want it to look like. And the reason for it is because money supply is convergent to nominal growth. And once money supply, so what happens is that central banks continue to be accommodative, but the multiple expansion effect that creates on assets is much weaker, because it is converging with nominal GDP growth. Last year was fantastic for risky assets, for a very, obviously, in hindsight, understanding what happened is that money supply growth shot while nominal GDP fell. So all of that excess money is directly generating multiple expansion in risky assets. I think that what we're seeing in 2021 is likely to be a different perspective. So you have to be very tactical. There's going to be a spike in inflation. It will not last. And the reason why it will not last is because we didn't solve the overcapacity problem of 2019. We perpetuated it, expecting growth to reduce the slack in the economy. It didn't happen. Then we had another crisis and we zombified. So we enter this recovery with more overcapacity than what we had before. And at the same time, technology has eaten away a significant chunk of the potential growth of the mobility factor of GDP. So I think that you need to be very tactical, and you need to be, understanding that cycles are very short, and that we need to have, obviously, many of the people that are listening, watching us, have long-term portfolios. So what you need to have is a good balance, because the problem in short but correlated cycles is that bonds and equities are very correlated. So you need to be sort of moving money around a little bit more than what one would usually be accustomed to.
Well, let's take a look at certain asset classes and get your opinion, understanding there may be nuances to being tactical depending on inflationary, deflationary, etc. I'll start with probably an obvious one. That would be very simply public equities. So it has been heavily skewed. Oh yeah, invest beta, invest passively, whatever, S&P 500. But there's so many losers in that broad beta basket. It makes sense, I think, debatable, admittingly, to be more tactical. So many people have turned their attention to FANGs, Tesla. We're going to get to that one in a second. Do you think this is the time to be more concentrated, although varying sectors within a public equity portfolio? Or are you still a believer in being just very beta and having effectively hundreds of positions?
No, I think you need to be significantly concentrated, because, as we mentioned before, monetary and fiscal policy are heavily directed to benefit very few things.
Yes.
So I think that in the terms of public equities, I've been warning everybody to stay away from Europe as far as you can, because it's not about what the European Central Bank does. It's about demographics, it's about currency, and it's about the currencies in the countries in which most companies have invested heavily, Latin America in particular. So I think that, for example, I really think that technology will continue to benefit, and that in the area that we like to be more involved in, technology is more in the engineering, artificial intelligence part of equities rather than the consumer exposed ones. I think that there's a case to be said about continuing to be positive about the U.S. banks, and in terms of bonds, we prefer we prefer corporate bonds. We stay away from sovereign bonds, except U.S. Treasuries, and we stay away from high yield bonds because the risk to price ratio does not compute for us. We think that you get too little yield for very high risk, almost bankrupt companies, and you get obviously negative yield, and for most sovereigns that are not delivering on the solvency that the market expect them to achieve in 2021.
I'm going to dive a little deeper into the public equity aspect in terms of being tactical. And again, the FANGs, et cetera, have done well. There is one company that's done amazing. Arguably, it's the greatest inventor and entrepreneur in the world. And luckily for us, he's not even that old. So hopefully he'll have a long runway, and that would be Elon Musk. And we may disagree on this one. The classic people that have been around a long time probably look at it and scratch their heads. I don't know how this is happening. But when you dig very deeply into that company, don't look at it as just a car company. That's a part of it, or a transportation company. It's a climate change company. It's a tech company, and it's a big data company. And if you look at what's going to be happening with autonomous vehicles and robot taxis, Tesla, if they dominate that, they will. The valuation could skyrocket. Even though I know classic people are going to look at it now and not quite get it, they've been shorting, they've been wrong. Do you think I'm too optimistic about Tesla, or I might be right?
I think that you have a very good point in what drives the multiple expansion in Tesla. The mistake that many of us, me included, made was to think, hey, the Japanese or the European car companies are selling more electric vehicles and building more electric vehicles and have more production capacity than Tesla, and it's valued at a fraction of what it is valued within Tesla. So multiples would have to somehow converge from the benefit of the electric vehicle sales of those companies to the multiples of a Tesla. And it's the opposite. And we learn that over and over in technology cycles. Why? Because if I build two things, one is extremely valuable and is likely to be very, very, very worthy, but the other is worth nothing, my multiples compress. And if somebody is doing this, and on top of it is doing everything that's attached to the high value that you just mentioned, big data attached to it, etc., then the multiples will expand. And I think that that's where we made the mistake in Tesla relative to other automobile companies, particularly European and Japanese ones. What I think is that for Tesla to continue to support that valuation, it can not be a traditional company. You see what I mean? Is that once it goes from being an idea and an innovation machine to transferring that from idea and technology to production chain and sales, that's when multiples compress dramatically. So if I was, I don't know what he will do. I would be very much considering starting to spin off parts of the company to continue to make it an innovation multiple expansion story. Because once it goes from being a great idea, it's like what happens with, for example, like used to happen, if you remember, with exploration companies in the oil business. They found a big oil field, the stock would go up, 50, 60, 70%. Then they had to produce. And once they started producing, multiples compressed quite rapidly. So I think that the story with Tesla can continue as long as it continues to be an innovation and technology story relative to a production, sales, and margin story, in which, as you said before, 90% of people will find that the multiples just don't add up. No.
Good points. And in the public equities market, there's been a trend of people saying the rise of EM, which generally emerging markets has not done so great. And they make decent points, but some of it is that the dollar is going to be much, much weaker. Who knows? Maybe it will be. I agree that, of course, I want to have some exposure to EM, but like I said earlier, I think I want to be maybe very, very tactical to certain Asian countries. But do I just want to say, oh, get out of US equities and put 80% in emerging markets? I don't want to do that.
I would agree with you completely. I always say to my students, emerging markets don't emerge. And
they stay emerging for decades.
Think about this. Anyone that's watching us right now, tell me which emerging economies are you talking about? Because they have been emerging for decades now. So the first thing that we need to understand is that the reason why we like emerging economies is because they are a very leveraged bet against the carry trade of the US dollar, as you very well mentioned. So historically, the reason why we like them is because it's almost a double beta adjusted bet on weak dollar, some economic growth, and you're going to get a 5% economic growth in the economy in 2021 worldwide, then this will deliver 10% plus return, and the carry trade on the dollar, give it another 5. No, that's fine. Unfortunately, it's very difficult to bet on that in 2021. Why? Because emerging economies work like that when their currencies don't collapse. However, we saw last year one of the biggest warning signs that I can imagine for an emerging market investor, which is that in the year that we saw the most headlines about dollar weakness, the Brazilian real was down 20-odd%. The Argentine peso, 20-odd%, the ruble, 20-odd%, et cetera, et cetera, et cetera, et cetera. Is that it was the evidence of fiat currency debasement, not weak dollar, strong other currency. And that, it makes it very difficult then to simply go out and say, let's buy emerging economies. What I agree with you is to say, look, no, hold on a second. We have the Asian economies that have, on one side, the monetary aspect that leaves them relatively stable, while you have the growth and the recovery there intact with a demographic factor that supports those economies. And I think that the demographic factor is always forgotten in investment banks or world leading international bodies analysis, is that you cannot bet in favor of a weakening demographic economies in which the monetary and the industrial complex are not helping either. Therefore, I agree with that, with the Asian factor. I would run away from Latin America in general. I think that the the big mistakes made in the past years of double deficits, of massive imbalances, and very, very weak productive sectors, and very exposed to the carry trade we mentioned before, makes it extremely risky. But again, I come back to the points. I think that India is always a good demographic growth alternative, in which at some point we all wish that the Central Bank of India would stop destroying the rupee in order to maintain bloated government spending. But but you have pockets of opportunity in emerging economies, but you have to be very tactical. I personally think the emerging market index, the Bloomberg Emerging Market Index or the JP Morgan one, will not perform better than the S&P 500 or the NASDAQ, and the level of risk that you have to take to choose the first one in favor of the two others is way higher. That's a key point for me, is how much more risk do you have to take in emerging markets to deliver the same return that you get on the S&P 500 or on the NASDAQ? And it's multiples. You have to take 3-4 times more risk in order to achieve, again, the same return. So why would you, is my point, no?
Yes, very good points. I agree and completely agree on India. Such tremendous potential. I don't know if they're going to get it right, but if they get it partially right, watch out. The next 20 years could be pretty amazing there. So something I would definitely keep an eye on. I do want to be mindful of time. I have two last questions left, but they're important ones. You probably knew this is coming. Bitcoin. What do you think about Bitcoin?
I think Bitcoin is a startup currency. It's not, I mean, to be money, it has to be a reserve of value, widely used, and a unit of measure. It does not comply with one of those three factors, to be a unit of measure. And I think that it takes time. But one thing that is true is that as a startup currency and as something that becomes gradually mainstream, it has gone from being an absolutely no discussion, not even touching it in the portfolios of institutional investors, to something to ponder. And I think that shows that it's slowly achieving a certain level of status as an investment. I don't own it at these levels, but I think that it will continue to be improving its worth particularly in the next couple of years.
Excellent. Very well said. And I think my last question, we'll see, it's the one asset class we really haven't covered yet, and a very important one, depending on inflation, deflation, stagflation, whatever, and that is broadly commodities. Now, of course, oil, gold, silver, agriculture, etc., but probably the one that most are going to be interested in, and some people find to be the Bitcoin gold argument, is going to be gold. But I'll let you broadly speak about commodities.
In commodities, I think, again, coming back to the point that we said before, you have to be tactical. I think that we'll see a first half of the year in which commodities will do well because of those three elements: base effect, recovery of the global economy, and supplier interference in the balance of the market. But you should not be very exposed to the commodity complex in general post that base effect. Gold, my opinion is that you need to have gold in a portfolio of balanced risky assets. I'm a long-term investor. I have to be invested all the time. I don't get out and come in. So my view is that I always give the analogy of a football team, is that you need to have linebackers. You need to have something that is going to defend a portfolio in difficult times. That's why I like to have dollar exposure and gold exposure, although they may seem counterintuitive, because they're both providers of support in correction times that allows you to take the opportunity to look at good opportunities to add into a portfolio. So I really like gold from a fundamental perspective. I think that central banks are going to and will continue to buy more gold as they increase their balance sheets. I think that the global supply demand scenario is pretty attractive, and I think that in an age of financial repression, it's a very, very good defense in a portfolio.
Excellent. And I did get a question in, and I think it's a good one, given your global perspective and you being a professor. So working with a lot of people, whatever, 18 through 22. And that is the question that I guess is asked, and I could relate to this as well, is what do I tell someone entering college to be? Now, you're not allowed to say follow their heart. That's too easy, given the fact that technology, artificial intelligence, robotics, so much is changing. I mean, everyone can't want to be an economist and be in the world of finance. Machines are basically going to start to make that more and more difficult. What would you recommend for someone to potentially have a livelihood, whatever that may be, over the next 40 to 60 years, or if we live to 200, like 170 years?
It might sound counterintuitive, but I think that arts, literature, history, everything that has to do with the human aspect of our day-to-day activity is going to increase in value significantly. Is the ability to provide a human factor to all this technology that's overriding everything. The more that societies move towards technology, the more that they miss, the more that citizens crave for the everything that has to do with emotions, with philosophy, with art, with. So I have one of my sons is studying English literature, and he's always concerned about his employability. And I said, don't worry. You're not going to have any problem. I'm worried about your brother, one of my other kids, that's studying economics. That's the one.
Yeah, there is an irony to that. I feel exactly the same way. And if you're able to be a listener, to have emotional intelligence, you'll be able to adapt to an environment if banks as we know them or decentralized finance, however that would play out. There's no, at least in anywhere in the foreseeable future, decades out, no computer could tell me describe how an apple tastes and really describe to me what love is. How does it feel? I mean, one day it may have singularity and possibly could do that. And even that's debatable. But there are things, the human side, like you said, I agree. And then hopefully there'll be money will follow.
Absolutely, absolutely, it will. The point is, again, coming back, is soft skills. I think that right now we have commoditized knowledge. So knowledge and technical capabilities are basically commoditized and probably will continue to be so. But soft skills, very challenging in this environment. One of the things that I see with my students is that they have lost many of them have lost the ability to manage themselves in complex environments with people from different cultures, different people from different environments. So soft skills are going to be absolutely critical, because I always tell them, look, all the knowledge that you have, you find on Google with a couple of clicks, but your ability to communicate, to move people, to follow, and to divulge, to create teams, all of those things, very, very important.
Yeah, I mean, I would look at Steve Jobs, the late Steve Jobs, and I mentioned him before. Look at the visionary and how engaging Elon Musk is. Those are things to maybe emulate and follow. Not saying that either of them are perfect, they're not. But nonetheless, from a visionary perspective and talking to people broadly around the world, very intriguing. How could people that would like to learn more about you, and your organization, your company, maybe follow you on Twitter, how could they learn more?
Yeah, you can follow me on Twitter. I have an English account. It's at DLACALLE_IA. So DLACALLE_IA. You also have my website, www.dlacalle.com. It's in English and Spanish as well. You have my YouTube channel, also in English and Spanish. It's not difficult to find me. So if you put Daniel Lacalle, you probably find a few ways of getting to see my work. But I would suggest my YouTube channel, my website, in which you also have my interviews and everything, and my Twitter account.
Of course, and I'm going to spell your name. It's Daniel, last name Lacalle. I'm a Twitter follower of Daniel's as well as YouTube. I think it's fantastic. He's one of my faves. It's been an honor to have you on. I definitely look forward a little later this year to having you back. If you have to run, I completely understand. I have to do a 90-second close, but it's been great to have you on, Daniel, and look forward to the next time. Everyone, I'm Angelo Robles. I'm the host of the Angelo Robles podcast on Apple, Spotify, and other platforms, and the founder and CEO at Family Office Association, a global membership organization dedicated to investors, families of wealth, and single family offices. Go to our website to learn more. We're very active during COVID. Membership is very easy. If you go to the website, you'll figure it out. FamilyOfficeAssociation.com. My direct email is angelo@FamilyOfficeAssociation.com. We provide unique proprietary content. We have private forums for families and investors to privately communicate. We host hundreds of digital programs every year. There will be some physical events this year and other services that we provide. So we're very active. Go and check it out. We're extremely active on social media. On YouTube, we're simply Family Office, and that also is my handle on Twitter as well. So go and check it out. Thank you all so much, and a tremendous pleasure. Daniel, thank you so much.
Thank you very much. A great
My
pleasure.
pleasure.